What if I told you that one of the world's most dynamic and rapidly growing economies achieved its success by breaking one of the fundamental rules of modern economics? We are constantly told that to build infrastructure, to invest in people, to weather crises, nations must borrow. Yet, in Southeast Asia, a nation has been quietly proving that narrative wrong. Vietnam, a country that has emerged as an economic powerhouse, boasts a government debt level that is shockingly low compared to its roaring growth. Is this sheer luck, brilliant foresight, or a completely different model for national prosperity? Join us as we peel back the layers of Vietnam's economic debt miracle. However, there is one very interesting indicator that stands out, and it is not a policy at all: government debt. This term refers to the total amount of money borrowed by a nation's government. In Vietnam's case, the government debt to gross domestic product ratio, which compares a country's total debt to the size of its economy, sits at approximately 39.6%. This figure is remarkably low and places Vietnam's overall debt among the lowest in all of Asia. To put this into perspective, let us look at some of Vietnam's neighbors. The Philippines and Thailand, for example, have debt to gross domestic product ratios of around 60% and 59.6% respectively. India's ratio is even higher, exceeding 89%. So, when you compare Vietnam's debt relative to its economy, it is significantly lower than many other Asian nations. This immediately raises a series of intriguing questions about Vietnam's economic growth strategy. How did this country manage to expand so rapidly and robustly without relying heavily on borrowing? Generally, debt is seen as a crucial tool for boosting growth in an economy or for individual companies. While it always comes with inherent risks, various forms of debt can undeniably contribute to economic development. One might logically expect the Vietnamese government to utilize debt for essential purposes such as improving national infrastructure or providing vital public goods to its citizens. Yet, it appears that the government has not extensively leveraged debt in its strategic approach to growth. There are several factors that contribute to Vietnam's restrained use of debt. But before we delve into those specific reasons, it is absolutely essential to grasp the general landscape of the country's government debt. The concept itself is quite straightforward. The Vietnamese government, much like any other government or even an individual, has the ability to borrow money both from within the country, domestically, and from outside the country, externally. Domestic borrowing can occur through a variety of instruments. These include government bonds, treasury bills, and loans secured from domestic banks. These are all ways the government raises money from its own citizens and institutions. In contrast, external borrowing involves partnering with international sources. This might mean working with bilateral sources, which are other countries like Japan, or with multilateral organizations, such as the Asian Development Bank and the World Bank. Understanding why governments need to borrow in the first place is also crucial to this discussion. There are common and legitimate reasons. One primary reason is to finance government spending on vital areas like infrastructure projects, essential public services, and social programs that benefit the population. Another reason is to manage budget deficits, which occur when government expenses surpass its revenues. And finally, governments often borrow to stimulate the economy, especially during crises, such as the global COVID-19 pandemic, when governments across the world borrowed massive amounts of money to support their countries through various relief and recovery initiatives. Having established this context, we can now examine the specific composition of Vietnam's government debt as it stood in 2021. According to data released by the Ministry of Finance, Vietnam had $46.5 billion in external debt and $95.4 billion in domestic debt. This totaled around $141 billion in outstanding debt for that year. While this is certainly a substantial sum of money, it is important to remember the context of Vietnam's rapidly growing economy. A significant portion of Vietnam's bilateral external debt, meaning loans from other countries, comes from Japan. Japan holds over $13 billion in loans to Vietnam, making it the largest bilateral creditor. South Korea and France follow. with $1.38 billion United States dollars and $1.3 billion United States dollars respectively. Among multilateral creditors, which are international financial institutions, the World Bank is the largest lender, providing $16 billion United States dollars. The Asian Development Bank is next, with $8.1 billion United States dollars. This detailed breakdown provides valuable insight into the specific sources and the sheer scale of Vietnam's government debt. Despite these significant borrowings, the overarching narrative remains that Vietnam's government debt has stayed relatively low when compared to other Asian nations. Now, we can address the central question: why does Vietnam's government debt remain relatively low, especially in the face of the country's rapid and sustained economic growth? There are various factors that contribute to this unique situation, and some experts even believe that this low public debt has been a key ingredient in Vietnam's overall economic success and its remarkable post-pandemic resurgence. An article published by the Friedrich Naumann Foundation for Freedom strongly asserts that the country's low government debt was a crucial factor that enabled it to quickly recover as a strong economy after the challenges posed by COVID-19. This suggests a direct link between fiscal prudence and resilience. Additionally, while Vietnam's debt to gross domestic product ratio hovers around 39.6%, numerous studies have explored the relationship between public debt and economic growth. For instance, 36 out of 40 studies published by the Cato Institute have found a statistically significant negative effect of public debt on growth. If these findings are accurate and generally applicable, they could help to explain why Vietnam's economy has flourished so impressively with its consistently low debt levels. It suggests that avoiding excessive borrowing might actually be a catalyst for, rather than a hindrance to, economic expansion. At its core, Vietnam's low debt can be primarily attributed to one powerful factor: the country's rapid economic growth has simply outpaced its borrowings. With one of the fastest gross domestic product growth rates in the entire world, Vietnam has consistently demonstrated strong fiscal discipline and exceptionally cautious borrowing practices. The government has been diligent and strategic in promoting steady, sustainable growth without falling into the trap of relying heavily on debt to fuel its progress. However, it is absolutely essential to note a significant nuance: some of Vietnam's debt originates from its state-owned enterprises. This distinction is crucial because the debt of these enterprises does not directly reflect the government's overall debt position. And it is also a contributing factor to the country's seemingly low debt profile when only considering government-specific liabilities. For example, state-owned enterprises in Vietnam play a very significant role in the country's economic development. They are particularly active and influential in crucial sectors such as infrastructure, energy, and transportation. These state-owned enterprises have often borrowed substantial amounts of money to finance their extensive investments and ambitious projects. However, since the debt of state-owned enterprises is considered legally separate from the central government's direct debt, it does not directly impact the government debt to gross domestic product ratio that we have been discussing as the primary indicator of national debt. But it is definitely worth noting that the debt of these state-owned enterprises is just as important as the direct government debt for the overall health of the economy. Because state-owned enterprises play such a crucial and foundational role in the economy, their financial stability has a direct and significant impact on the country's overall economic health and well-being. A high level of state-owned enterprise debt could potentially put a severe strain on the national financial system, dramatically increase the risk of widespread defaults, and ultimately lead to serious economic instability. A key and stark instance that illustrates this point is the Vinashin case. Vinashin, which stands for the Vietnam Shipbuilding Industry Group, was a massive state-owned enterprise that experienced severe financial difficulties and came perilously close to collapsing entirely due to chronic mismanagement and widespread corruption. In 2010, the company famously defaulted on a $600 million United States dollar international loan. This catastrophic event led to a significant loss of employment for the Vietnamese economy, a substantial loss in taxation revenues for the government, and a further loss in the operational efficiency and profitability of other state-owned enterprises. More importantly, it directly resulted in a downgrade of Vietnam's credit rating. Moody's Investor Service specifically downgraded Vietnam's credit rating from B1 to BA3, citing not only terrible issues related to the broader economy but also explicitly mentioning Vinashin as a key reason for its downgrade. A credit rating downgrade can have profoundly significant implications for any country. It can lead to much higher borrowing costs in the future, reduced access to crucial international capital markets, and a sharp decline in overall investor confidence, making it harder for the country to attract foreign investment. It is important to consider not just the sheer amount of debt a country has accumulated, but also its fundamental ability to repay that debt. Countries like Japan, for example, have an astonishingly high debt-to-gross domestic product ratio of over 264%. Yet, Japan can sustain such high debt levels because it possesses an immense capacity to repay its obligations. This then naturally leads to the critical question for Vietnam. Can Vietnam repay its debts effectively and sustainably? From a domestic perspective, Vietnam holds about $95.4 billion United States dollars in debt borrowed from within its own borders. Domestic loans are generally much easier to manage than external loans. They significantly reduce currency risks, enhance a nation's fiscal sovereignty, and offer other important benefits. Some economists even put forth the argument that countries can, in a sense, print money to pay domestic debts, although this approach certainly carries its own set of risks and potential inflationary consequences. Repaying domestic loans is usually more manageable because governments have several tools at their disposal. They can use tax revenues, raise funds from other domestic sources, or, in extreme cases, increase the money supply. When it comes to external debt, the situation becomes considerably more complex and challenging. External debt involves significant currency risks, often comes with higher borrowing costs, and leaves a country vulnerable to various external economic shocks and geopolitical pressures. To effectively repay external debts, countries typically use their foreign reserves. At the time of this writing, Vietnam's foreign reserves stand at approximately 83 billion United States dollars, which is nearly double its external debt. This robust level of reserves strongly suggests that Vietnam is managing its foreign borrowings very effectively and responsibly. In addition to drawing on foreign reserves, the Vietnamese government can finance its external debt through several other means, including robust export earnings, strategic debt refinancing, and, in some cases, carefully negotiated debt restructuring. Now, it is worth delving into the core reasons behind the Vietnamese government's relatively limited use of debt in its ambitious strategy for promoting economic growth. This is where we uncover the specific approaches that differentiate Vietnam. Firstly, Vietnam's deeply export-oriented economy has played a hugely significant role in maintaining its low debt levels. By strategically focusing its economic efforts on exports, the country has successfully attracted substantial foreign investment and experienced truly rapid economic growth. This outward-looking approach has led to a consistent and healthy flow of foreign exchange earnings into the country, which in turn has greatly helped Vietnam manage its external debt more effectively and reduce its reliance on new borrowing. Efficient public expenditure is another absolutely key factor in this equation. The Vietnamese government has made it a clear priority to meticulously allocate its spending into sectors that possess the highest potential for both sustained economic growth and broad social benefits for its citizens. This highly focused and strategic approach has optimized government spending, ensuring that every dollar spent generates maximum impact and consequently reducing the overall need for excessive or unplanned borrowing. Macroeconomic stability is yet another vital factor underpinning Vietnam's debt miracle. Vietnam has managed to maintain an impressively stable macroeconomic environment. This stability is characterized by consistently low inflation rates, a stable exchange rate for its currency, and exceptionally sound fiscal policies. This overall macroeconomic stability has made it considerably easier for the government to manage its existing debt obligations and to consistently maintain that desirable low debt-to-gross domestic product ratio. Finally, structural reforms and extensive economic liberalization have played an indispensable part in Vietnam's remarkable success story. The country has undergone significant and far-reaching reforms and has progressively liberalized its economy over the past few decades. These changes have led directly to greater efficiency, enhanced productivity across various sectors, and a marked increase in overall competitiveness in the global market. These profound reforms have contributed immensely to Vietnam's rapid economic growth and have simultaneously reduced its inherent reliance on debt financing to fund its development. In conclusion, it is essential to consider future expectations, especially since developing countries often experience an increase in public debt as they progress along the path towards becoming fully developed nations. In some cases, their debt to gross domestic product ratio may even exceed 100%, meaning that public debt surpasses their annual economic output. So, the crucial question is, will Vietnam follow a similar trajectory and see a significant increase in its debt if and when it officially becomes a developed country? Predicting the future is, of course, always an exercise in uncertainty. But based on current trends and historical behavior, it appears that the Vietnamese government has not relied on debt as heavily as many other nations to achieve its growth. This distinctive tendency may very well continue in the long run, shaping a different path for its economic development. Notably, during the immense global challenge of the COVID-19 pandemic, when many countries worldwide saw their debt to gross domestic product ratios dramatically increase by 10 to 20% or even more, Vietnam's ratio showed remarkable resilience. It only rose marginally from 41.5% in 2019 to 41.8% in 2020, before impressively dropping back below 40% in 2021. Given that 2020 was an exceptionally challenging year for the global economy, Vietnam's performance in managing its debt appears truly impressive and stands as a testament to its cautious fiscal approach. The debt miracle of Vietnam continues to unfold, offering valuable lessons in economic management.